and we're almost at all-time highs in gold, and we're nowhere near all-time highs in silver, and it's kind of boring, and Bitcoin took all the show. There's a lot going on underneath the surface. It was the largest weekly registered gold inflow ever on the COMEX. It's rivaled only by the March 2020 lockdowns. That is why gold open interest has increased by 130,000 contracts over the course of January. This does not count the spot deliveries that have happened in January, which is not an active delivery month, but still there are record amounts of deliveries for an inactive month in the gold futures market. There's never been a month like this. Something big is boiling. It's definitely going to happen this year. We're already on trajectory for it.
Before we show you more clips, smash the subscribe button and join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
The first thing we have is the second biggest month of COMEX registered gold inflows ever. This bar here, this blue bar, shows the monthly increase in registered supplies. Registered, of course, is gold for delivery against contracts, meaning it's for sale against futures contracts. Eligible gold is not, it is privately owned. Both are increasing. Registered gold even faster, which means that whoever is importing this gold expects to deliver it into a contract. Otherwise, they would remove the warrant from it. So we have here, it looks about to be between 0 and 5 million, so that's about 2.5 million ounces. That was only bested by, I think this is May or June 2020, when we had just below 5 million ounces, but this is the second biggest importation of registered gold supplies ever. And if we go to the weekly charts, we can see that this week was just about 2 million, just below 2 million ounces. This is pretty nuts. 2 million ounces of gold, and it touched that barely in one of the months of 2020. This could be maybe May, somewhere around April or May of 2020. I don't know which one is bigger, this one or that one, because the resolution is not big enough for me to tell, but you know what? It doesn't really matter. This week, what is happening is that this is a tariff dodge. Gold importers are trying to get away from the tariffs of the Trump administration, which will tariff everything that comes to the country, probably including gold bullion, but that has not been enacted yet. So these traders are trying to import, whoever they are, they're trying to import gold before the tariffs come into effect, and that is creating record amounts of gold importation, physical gold importation into the COMEX. If we go to this slide over here, this shows 133,000 new contracts in January on the COMEX. See here, in the 2025 begins, we're at about 450,000. Right now we're at 571,387, so that's about 133,000 new contracts. And this does not include the deliveries that have already been made, and I'll show you that in the next slide. My point here is that we usually see, after a surge in open interest like this in gold, the open interest falls down. As it falls down, what happens is that price falls with it. I don't think that's going to happen this time, because these increases in open interest are probably also tariff dodgers that are trying to get physical gold before the tariffs come in. And you know what? Those that open the contracts, they don't have to pay the tariff. The ones that import the gold have to pay the tariff. So I think people are importing gold into the COMEX in order to fulfill delivery on these contracts. So as the open interest on this falls, I think these deliveries are going to be made, and it's not going to affect the price. What affects the price as open interest falls is that longs sell their positions rather than taking physical delivery, and because they sell their positions, the dollar price moves. But on delivery, the dollar price does not move. The contract is satisfied by gold being delivered. So I don't think that that open interest falling is going to affect price negatively here. And if we move to the next slide here, we can see the monthly deliveries. This is 15,642. Isolated, this doesn't look like anything special, but this is a non-active delivery month. So 15,642 deliveries is a record, all-time record for gold deliveries in a non-active delivery month, right? There's active delivery months. They happen like every 2 or 3 months. It's usually like December, and then March or April. I think June is a popular one, but this is a non-active delivery month, so open interest is usually small. This is the most deliveries ever made for a non-active delivery month, which means that importers are trying to take delivery now, and they want to do this before the tariffs kick in. Now we're going to compare this with the open interest situation in gold during the 2020 crisis, the lockdown crisis, what happened here is we had near record high open interest, and then it slammed down from about 750,000 to 450,000, let's just say 300,000 contracts, whatever that is. It's not exactly that, but it was a huge fall in open interest, and that was the gold crash that we all remember. And price went down from about 1,700 to 1,450. Price went down from about $1,700 to $1,450, somewhere around there. And we had this huge smash in open interest. We also had record deliveries. Now you could say, well, maybe that's going to happen this time. We're going to have a smash in open interest and a smash in the price and record gold deliveries. However, back then there was a huge dollar crisis, a dollar panic, because the world was shutting down and people couldn't service their dollar debts. That's not happening this time. We're not quite in a dollar crunch yet. So that means that there's not a rush for dollars. There's just a rush for gold before tariffs get in the way. And so as open interest falls here, as deliveries are taken for the active month, which closes in about 8 business days, 7 business days, 6 business days, something like that. January 30th is the last day. And open interest is still about 250,000 contracts. So I think that as we've seen record deliveries for a non-active delivery month, we're going to see record deliveries, I hope. In an active delivery month in all time, I think the record is 55,000 warrants delivered. I think it's going to be more if people are really trying to get around tariffs for gold importation.
In today's news recap, gold glitters near record high levels after Trump's comments. Gold prices rose nearly 1% on Friday, lingering near record high levels scaled in October, steered by U.S. President Donald Trump's calls to lower interest rates and uncertainty surrounding his trade policies. Spot gold rose 1.1% to $2,784.82 per ounce and was up 2.8% for the week. Prices are at their highest since October 31, when they hit a record high of $2,790.15. Gold's move towards a fresh all-time high has coincided with a correction in the dollar, which is lower following remarks by Trump that suggest he may go soft on tariffs and settle for a trade deal with China, independent analyst Ross Norman said. We see gold is likely to hit $3,175 during 2025. On Thursday at the World Economic Forum, Trump said he would demand that interest rates drop immediately. In an interview with Fox News, Trump said he would rather not have to use tariffs over China. Zero-yield gold is known as a hedge amid political and economic turmoil and tends to do well in a low-interest rate environment. Trump's remarks come before the Federal Reserve's meeting next week, where the policymakers are widely expected to leave rates unchanged. Now we'll show you the best clips of the latest interview.
Subject I want to go into is a little bit on timing. We have the extraordinary accounting measures beginning yesterday. The Treasury has announced that the debt ceiling has been hit, and now it is spending down its account at the Fed, and those dollars are going to go back into bank reserves. So the last time this happened, January 25th, 2023, at $572 billion, excuse me, down to $48 billion by May 31st, 2023. So that's about 4 months, January, February, March, April, May. It took about 4 months for the account to be emptied. So we can expect we're at around the same level right now, about $600 billion it shows here. Maybe a little bit higher than that, but it's going to take about 3 or 4 months depending on how fast they spend down the balance. And once that balance is spent down, they're going to have to raise this debt ceiling. Once they raise the debt ceiling, this black rectangle here, this was the extraordinary measures that I showed in the previous slide. So the extraordinary measures happen in this rectangle, and you can see the blue line here is the Treasury's account at the Fed as they spent down that balance. Reverse repos were at about $2 trillion. And then once the Treasury's account ran out and they raised the debt ceiling, the Treasury raised a whole bunch of cash over here from about $48 billion to about $800 billion. So let's just say $750 billion. And reverse repos fell by about $1.4 trillion in that time. You see, now the difference is there are no more reverse repos, at least they're not substantial. I think they are below $100 billion. They're not really significant anymore. That has been emptied. So if the Treasury wants to raise a whole bunch of money after the debt ceiling is raised, where are the dollars going to come from? Last time they came from reverse repos. This time there are none. So where are they going to have to come from? They're going to have to come from here. The bank reserves. This is the 3 trillion point something bank reserves. I think it's about 3.3 trillion now. The crisis line is $3 trillion, which I've shown before. That is the number we were at during the March 2023 regional banking crisis. If we break below this line for any substantial amount of time, let's say a month or two, we're going to have the final crisis on our hands, and QT, as that continues, is going to bring that closer and closer. So what's going to have to happen? The Treasury is going to have to spend down its balance of about